This conference will now be recorded.
Good evening, everyone. I'd like to welcome you to the First Advantage First-Time Homebuyer webinar with David Wright tonight. Our presentation will be in listen-only mode, which means you will not be able to interact with the speaker verbally. Please keep yourself muted throughout the presentation. But if you do have questions that pop up, please feel free to put them in the chat box down at the bottom of your screen, and we will answer them throughout the presentation or at the end. And lastly, I did want to mention that the webinar is being recorded. So without further delay, I'd like to introduce David. David, are you ready?
Hi, everyone. This is David Wright, Mortgage Sales Manager at First Advantage. And I'll share a little bit about me in a second. But first, I want to thank you all for attending. I appreciate you taking time out of your busy schedule to come. And also, I'm very excited that you are embarking on the American dream. Buying your home is wonderful. You have no landlord. You can paint your walls purple if you want. Your home appreciates over time. And for those who are fortunate enough, one day you will pay your mortgage off and have no payment. So we are going to get started with the basics of purchasing a home. And a little bit about me. I won't go into great detail, but I am the mortgage sales manager at First Advantage. I've been in the mortgage industry about 20 plus years, and I am a Peninsula native. So born and raised, born in Hampton, live in York County, and went to school here and went to Christopher Newport College at the time, now Christopher Newport University. So the first thing about buying your home, number one, is defining your needs. And this would be, obviously, where do you want to live? What do you want your house payment to be? You obviously want to make sure that you don't take on a payment that doesn't fit in your budget. We'll talk about that some more. Pre-qualification, and that's going to be the mortgage pre-qualification and what you need to do that. Talk about choosing an agent. Always when you buy a home, if you can, you should use a real estate agent who is a professional and will help you through legal aspects, navigate your contract, etc. Somewhere along the way, then you will find a home. And I'm sure most of you have watched all those wonderful HGTV shows where they go out and look at multiple homes and make their offer and get their offer accepted. And at the close of the 1 hour show, they're in their wonderful new home. So it doesn't quite happen that quickly, but it is exciting and it can be a great journey if you'll do it right. You'll find a home, of course, then you have the purchase contract. We're not going to go into great detail about that. That's more of your real estate agent related, but that is a piece of the puzzle. When you do make an offer and it is accepted, you have a home inspection. There is a lender appraisal, and then there is a loan process to this. So some of the key questions would be, most importantly, how much payment can I afford? Now, often you'll hear, well, how much can I get approved for? And that's wonderful. But you want to make sure that you keep the payment where you want it, because obviously when you buy a home versus renting, you do have a lot of other expenses. You've got a yard, and therefore you've got to buy a lawnmower, and you've got to buy gas for the lawnmower. And every time the toilet breaks, you have no landlord to call. You have to pay for it yourself. So these are key important things, because even though your rent may be a certain number, if the mortgage payment is the same number, that's wonderful. But when you own a home, you're going to have other expenses that you simply don't have when you're renting. So you always want to make sure that you fit that number into whatever makes you comfortable, makes your life work, and therefore you're not eating ramen noodles for the rest of your life. You don't want to be house poor, as they say. What type of home am I looking for? So these are the things you're going to discuss with your real estate agent. They're going to ask you things like, what neighborhoods do you want to live in? What zip codes do you want to live in? How many bedrooms? How many bathrooms? The school systems, etc. So these are all important factors when you're looking for a home, and this is why a really good real estate agent is going to be your best friend. How long do you want to be in the home? Obviously, when you buy your first home, in most cases, a person tends to stay there for 5, 7, 10 years, and then oftentimes they might outgrow that house. They may have a family, children, dogs, cats, and at some point they may decide, hey, it's time to sell and move on. But for now, you want to think about how long you want to be there. You would not want to necessarily buy a home that you knew you were going to be moving from in a year or two. So buying a home is a little more of a long-term proposition, and you want to make sure you stay there long enough to let your equity build, let the value grow, and make it worth your while when you do sell. School system, of course, that's important, and that's also going to be related to your search when you work with your real estate agent. So where do we begin? Well, number one, you want to make sure you're pre-approved, and that's the main topic of this workshop, is to talk about how you get pre-approved, what goes into it, and it's important that you do this before you start your search. So as we go through this, you'll see there are things you're going to want to put in place, and as I always tell clients, when you buy a home, you want to do it right. It should not be a rush. It should not feel too much pressure. You want to do everything in order. So first things first, when you're pre-qualifying with a lender, job stability is a key item. So you want to make sure you have 2 years or more, either on your current job or at least in the same industry. For example, you're a teacher, you work for XYZ school system, and you've been there for 2 years, you transfer to another school system, you've been there 6 months now, but that still works because you've had 2+ years in your industry, and it needs to be full-time. Now, part-time income can qualify. However, there are other guidelines regarding how much part-time income you've had, how long you've been there, and so forth. So full-time employment is really the key, and that also speaks to your stability, not just in pre-qualifying, but you want to make sure there are going to be no hiccups in your income or your employment, because once you buy a home, it's not like renting. Once you bought it, you bought it. And that's a mortgage payment you're going to have for a while. So you want to make sure that your employment is solid. We'll talk about credit in a few minutes. And obviously, we'll also talk about liquid assets and down payment. Now, what I would encourage you to do, just take a quick pause. If you have something to make notes on, please feel free. If you don't, it's perfectly okay. We'll be available to reach for any other questions, which you'll have many after this. This is simply an overview, but if you're taking notes and maybe even writing down your questions that you're going to have as we go, so that we can answer your questions in the chat at the end of this presentation. So how much home can I afford? Well, number one, we talked about budget. So think about what your budget allows. Again, you might qualify for a $1,700 or a $2,000 payment, but is that the payment you want? So don't be sidetracked with what you can pre-qualify for. Stick with your budget. That's important. What are you comfortable with? So you could qualify for more than that. You could qualify for less, but you have to stand your ground with your own family on your budget, with all the other expenses that come with buying a home. So debt to income ratio would be the next piece of the puzzle. And debt to income ratio is basically taking all of your monthly debts. So that would be whatever your new house payment's going to be. If you decide, hey, I want my payment to be $1,500, that's the number I'm happy with. That's the number that works. That's going to allow me to continue to save money, put money in my 401k, continue to go to the movies, although you can't go to the movies like you used to with COVID, but you still have entertainment, you still have cable TV, you still want to go out and eat, you still want to go on vacations. So whatever the house payment is that you want, that would go there. And then you're going to add all of your other monthly consumer payments. Now, these are not utilities. These are not cell phones. These are not insurance. It's literally just debt. For example, it could be a car loan, could be an installment loan, could be a student loan, could be credit cards. So whatever those payments are, car, credit cards, installment loans, student loans, all of those monthly payments, those are debts. Remember, they're not utilities, they're not cell phones, they're not insurance, they're the actual debts. All of those, along with the house payment you want, are going to then be grouped up together. If you see the line there where it says new monthly house payment plus all monthly consumer debt payments. So that is your monthly debt from a qualifying standpoint. All of that's going to be divided by your gross monthly income. Now, gross monthly income is pre-tax. So it's before they start taking out taxes, 401ks, and anything else you have taken out of that income. It is your gross income. Now, if you're self-employed, it's a little different. So let's talk about that for a second. If you have a traditional job, full-time, 40 hours a week, or you have a salary, that is your gross monthly income. If you're self-employed, it's a little different because you don't have a set income. You have tax returns that you have a gross income that you brought into the business, but then you started writing off things, and at the bottom of those calculations, you have a net. So if you're self-employed, it's a little trickier to calculate this, and that's where your loan officer will need to help you take your tax returns. And in the mortgage lending industry, we require the most recent 2-year. So for example, 2020 and 2019, and your loan officer will help you with those tax returns to calculate what the lending industry is allowed to use and compute as your gross monthly income. Now, the question gets asked quite often, well, what if I am commissioned? Well, that again is a little different because your income varies. Your loan officer can help you with that. What if I make overtime? What if I make bonuses? Well, those are incomes that can also be added. However, only your base pay is your starting point, and then your loan officer will help you calculate the commission and the bonuses to come up with your actual full gross monthly income. So this calculation then is taking all of those monthly debts, house payment you want, consumer debts, credit cards, student loans, installment loans, car loans, and dividing it by the gross monthly income. That is what's called the debt to income ratio, or DTI. So in our example, if your new house payment that you want is $1,200 a month, and your credit cards total $400 a month, and by the way, credit cards, we do not calculate what you might actually pay because most people pay over the minimum. We only use the minimum that's reporting on your credit report. So if you have a credit card and the monthly payment's $50 a month, but you say, well, gee whiz, I pay $300, I pay extra, like most people do, the lender is only going to have to count the 50 against you, the minimum that's showing on the credit report. So you have your house payment of $1,200, or at least that's the one you want. Credit cards, for example, they total $400 a month as the minimums, monthly payments. You have a car of $400 a month. We group that together and we come up with what's called your total debt. And in this example, that's $2,000 a month. Then, for example, let's say you tell your loan officer, hey, I make $60,000 a year as my gross pay. Now remember, that's not your take home. None of us take home our gross, do we? We have taxes, we have 401ks, we have all kinds of things coming out of our income, and that's what we take home. But remember, this is not take home income, it's your gross monthly income. So in this example, this person says, hey, I make $60,000 a year. That's my salary. Okay, well, $60,000 a year divided by 12 months is $5,000 a month. So in this example, we've got $2,000 of debt a month. We've got $5,000 of income a month. And as you can see in the little box down at the bottom, the debt to income ratio, or as we call it, DTI, is 2,000 divided by 5,000. That's 40%. Well, is that a good number? Is that a bad number? Well, it depends. Most loan programs, generally speaking, require this debt to income ratio to be under 45%. However, I'll caution you that the lower the number, the better. Or let me rephrase that. If you're close to that 45 or a little over the 45, that's a gray area and you might not qualify. So you want to try to keep this number as low as humanly possible so that you have no question about bumping into that line in the sand where 45 might not work. In some cases, based on your total profile, which is your credit, your income, this debt to income ratio, your assets, that's money in the bank, money in a 401k, etc. In some cases, if that total profile is weak, the debt to income ratio might need to be 40 or less, might need to be 35 to work. So even though 45% is the number that is typically considered the ceiling, just because you're below it does not mean it works. And if the rest of the total profile is weak, for example, if you have a table in your kitchen with 4 legs in it and you knock one leg off, the table's not stable. You knock 2 legs off, the table falls. So each piece of the puzzle, debt to income ratio is 1, credit is 1, assets are 1. These are pieces that go into the total. So this is the debt to income ratio calculation. Keep it as low as you can, and then let your loan officer assist you with getting pre-approved with your total profile. All right. How important is credit? Well, obviously credit is extremely important, but there are parts to credit that matter. You have your scores, you have a credit history. Have you ever been 30 days late, 60, 90? Do you have collections, things like that? Or is it clean? Or is it clean recently? Last 12 months, last 24 months? Maybe you had some issues in the past, but they're a couple years behind you. They will more than likely have no bearing on qualifying. More likely, if they're current, they could. Also, if you've had any significant events, foreclosures and bankruptcies, for example, they won't necessarily preclude you from qualifying. However, there's typically waiting periods that a person has to be out of foreclosure or out of bankruptcy before they're allowed back in the door to qualify again. For example, if the foreclosure window was 4 years, you'd have to be past that 4-year window in order to be able to qualify at all. If you are within that window, you would be shut out from qualifying at the moment, but it's not forever. It just means you've got to get past the waiting period first. In addition to getting past the waiting period, you have to have reestablished credit and had good credit. So a person may have had a bankruptcy, it was discharged, they're outside the waiting period, they've reestablished credit, their scores are back up where they need to be, they've been current on all of their debts since that window, since that bankruptcy, they would be good to go, more than likely, assuming the rest of the profile still worked. So let's go back to scores for a minute. In the mortgage lending industry, we're the only industry that I'm aware of that pulls all 3 credit bureaus. For example, if you go to First Advantage or to a bank or wherever you go and buy a car, more than likely that institution's only going to pull 1 credit report from 1 bureau. It could be Equifax, it could be TransUnion, it could be Experian, but they'll probably only pull one, and that's the number. In mortgage lending, however, we pull all three. And from the three, the middle score, not the average, but the middle. So there's one that's the highest, one that's the lowest, and one right in the middle. Whatever the middle score is, we call that the indicator score, and that is the score that drives the approval. Now, it would be important then to also talk about the difference between lender pulled scores and consumer pulled scores. For example, more than likely, every one of you probably subscribes to Credit Karma or some other consumer reporting agency. You might even be subscribing to the Equifax consumer score program. You might be subscribing to the Experian consumer score program. However, those consumer score programs are not actually the real credit bureau scores. What they are credit models. They're modeled after the actual bureaus. But lenders do not pull those scores. Lenders pull the actual scores. And so it's important because often you may have a Credit Karma score or an Equifax consumer model score and think, wow, that's my score. Well, it's a modeled score. It's one based on their model, but it's not the actual credit bureau score. So keep that in mind, because often that score from Credit Karma or from the Experian credit model, consumer credit model, is likely to vary from the one the lender pulls. And I share this because I see this extremely often where there's frustration in my clients or other consumers where they say, well, geez, Dave, my Credit Karma was a 740, but when you pulled my Tri-Merge, my Equifax, Experian, and TransUnion lender pulled scores, I've got a 728 and a 718 and a 705. Why? And it is frustrating as a consumer because we have not been educated or told by the credit industry that that's how it works. And so the Credit Karma scores are great, but they're not likely to be the ones the lender pulls. Now, the lender ones could be higher, but keep that in mind, please, so that when you have your Credit Karma and you have your Equifax and you have your Experian, please know that they're probably not going to be the exact same that the lender pulls. However, it still is a good indicator of where your scores are moving. For example, a year ago, your Credit Karma was a 620. 6 months ago was a 660. 2 months ago was a 705. Well, that still 705 might not be the score the lender's going to pull or get from the actual bureaus, but it does tell you something. It tells you your scores are going up. All right. Credit history, that's typically important only in the sense that normally the last 24 months of your credit history, meaning 30-day lates, 60-day lates, 90-day lates, or any collections, things like that, that's the window that's generally the most important, the last 24 months. Now, when I say 30 and 60 and 90-day lates, what I mean is a person might be thinking, oh, wow, I'm always 5 days past my due date. I'm always 5 days late on my credit card. Believe it or not, until that consumer account becomes 30 days late, does it get reported to the bureau and affect your score. So if you're 5 days late, you'll probably pay a late fee, but your score is unlikely to be affected because until it hits that 30-day threshold, it doesn't get reported as late and it does not affect your score as such. So make sure that you don't go 30 days late on consumer accounts if it's all humanly possible, because that is a score hit and you want to avoid that. All right, let's talk about improving credit scores for a minute. there are really only a couple things you can do to make scores better. Number one, of course, if you have any collections, just pay them off. Collections steal points. So if you have a collection out there, the collection agency is reporting every month that you're in collection and you're losing points. The moment you pay those off, those collection accounts die, meaning they no longer report monthly and they no longer steal points. Now, paying off collections will not necessarily make your scores rise. They will simply stop your scores from dropping. Number two, you want to continue paying all other creditors on time. When you make your payments on time, you get points from that, obviously. And number three, and this is the magic, is keeping your credit card balances under 25% of the limit at all times if you can help it. So let's talk about the credit card bonus scoring model. If you notice on the chart, at the top you have a credit limit. Maybe it's $1,000, maybe it's $10,000. Whatever it is, there are going to be zones in that credit card. You've got at the top, for example, between 75% of the limit and the actual limit. Notice the big red minus symbol. You will actually lose points if your credit card balance is in this zone on the day it reports. Now, unlike Credit Karma, unlike the consumer models, those models report real time. You can pull your score up every day and it will show you what it is. But the actual bureaus only receive the data from your actual creditors once a month. So it doesn't matter what your balance was on the day before Capital One reported to the three bureaus, and it doesn't matter what your balance was the day after Capital One reported to the bureaus. It only matters on the day it reported. Well, of course, the next question then, well, geez, Dave, what day does Capital One report? Well, I don't know. Now, you could call them and they'll probably tell you something like, well, we report on or about the 15th, or we report on or about the third weekend of the month. Well, on or about means on or about. So whatever your balance is on the day it reports, that's what causes the score or causes this relationship of balance and limit. In that top zone, you lose points. The next zone down, you lose less. The one below that, which is under 50% of the credit limit, you actually get bonus points. You don't only get your 3 or 5 points for paying on time, you also get bonus points. And under 25% of the limit, and actually, I believe one of the bureaus is 15%, but this is a generalization, you get extra points. It's like steroids. Now, how would you keep it under that if you, like a lot of people, they use their credit card for everything and anything, and then they just pay it off. But if you didn't know what day Capital One reported, you might get caught with running it up, and then it reports, and you're in that high zone and you lose points, and you pay it off the next day and you get no benefit because it's only the day it reports that matters. So you can either try to sort of game the system and figure out when it reports and pay it off or pay it down accordingly, or you can just keep it under 25% of the limit all the time, and then it doesn't matter what day of the month it reports. This is probably the single most important way to boost a score over time than anything else you'll ever do. My son, when he was in college, he got one of those traditional college student credit cards, $500 limit starter card, baby card. Well, me understanding how this works, fortunately as his dad, I went ahead and helped him open one. I took the card away from him, of course. I didn't want him to have it and use it improperly. And sure enough, kept the balance under 25% of the limit. And sure enough, 3-4 months later, he started getting offers from everybody. So we opened a second one. And in his particular case, because I know how powerful credit cards are, we opened a third. Well, wouldn't you know that when my son graduated from college, his credit score was in the mid 700s. Now, he never had the cards that whole time, and he had no other credit. But that's the power of credit cards. All right, down payments. Now, when it comes to down payments, some programs require them, some do not. So we're not going to go into great detail about which ones do and which ones don't. There are multiple programs out there. There are VA loans for veterans. That's a 0 down payment. There are USDA, United States Department of Agriculture loans for rural areas like Gloucester and Isle of Wight, parts of York County, parts of James City County, New Kent. That's a 0 down. There are FHA loans that has a down payment, and there are conventional loans that has a down payment. So we're not going to go into great detail, but some do and some don't. Now, the ones that require down payment or do not require down payments, most of them have income limits, meaning that you can't make over X amount in your household to qualify for that 0 down program. VA would not be one of those. You can make as much money as you want and it's still 0 down. The point is that when you're going to get a mortgage and you're going to get pre-approved, your loan officer is going to go over with you the different programs, what they do, whether they have down payments or not, which ones would be the most beneficial, and compare them to try to find you the one that fits you the best. All right, closing costs. Now, when you buy a home, typically there are a thing called closing costs. And again, we're not going to go into great detail. We're simply going to say that often, but not always, the seller will pay these on your behalf or part of that. This is why you need a real estate agent, so they can help you negotiate that, because if you're buying your first home, you're number one thinking, wow, I might need a down payment. Gee whiz, I might need closing costs too? Wow. So this is going to be important then with your agent to work that out so that all parties, you, the agent, and your loan officer are working together to come up with the one that works for you the best. Mortgage loan options. We kind of covered that just a touch, but here are some examples: conventional, FHA, VA, USDA. Each applies differently. Some have income limits, some have geographic restrictions, but your loan officer is going to help you unravel all of this to come up with the one that's right for you. All right, the loan process. Number one, there are a certain amount of documentation that's required. Typically, this is your pay stubs, your W-2s. If you're self-employed, it means tax returns, checking and savings statements to show your assets. One example, if you're a veteran and you're getting a VA loan, you'll need a DD-214, which is your separation form, or a statement of service if you're active duty. If you're self-employed, you'll also need 2 years of business tax returns if you file business tax returns, versus some self-employeds file a single form in the regular returns. Then there's the loan submission itself, the loan approval, and then of course at the end of the line is the funding and settlement. And then of course you close. All right, finding the right real estate agent. And let me go back before I jump too far ahead. This part of the process is the part where you get pre-approved. So you call your loan officer, you say, hey, I want to buy a house, I want to get pre-approved. What do I need to do? Your loan officer is going to take information, or more than likely and more efficiently ask you to go online, fill out the online application. They will have to pull credit because that's the only way to know what you're qualified for. And then they're going to ask you for these documents. Remember that debt to income ratio calculation we went over? Remember the thing, there were assets, maybe you need a down payment, maybe you don't. These are the documents that are going to help guide the loan officer to know, A, what are you qualified for? What's your debt to income ratio? You know, do you have the money for a down payment if That's the program you're getting, etc. So there are more documents needed than just the ones listed, but this is just an example and an overview that would be part of the process. All right, real estate agent, it's really incredibly important to find the right one. It really is. And the best way to do this, in my opinion, is not to go into Google and Google real estate agent in my area. Now, if you have to do that, fine. In my opinion, you want someone that is in your personal network, maybe a family member, maybe a friend, maybe someone at work says, oh my gosh, I just bought my house and I work with so-and-so and they were awesome. That type of thing. And the reason for this, that real estate agent is like your attorney in the courtroom. They are representing you and they are representing your best interest, and they want this to work for you. They want you to be high-fiving them at the end and coming out like a hero. And that person then should be someone that has your best interest at heart. And who normally has that? Your family, your friends, or someone that's recommended to you by someone you trust. Now, the buyer's agent, and you're the buyer, your agent's commission is generally paid by the seller. So it shouldn't cost you anything. It's in your best interest to have them. They have access to the multiple listing service, which means that they will be able to have access to all of the properties on the market in the areas you're looking. A couple other items, we're going to just run through these because these are going to be more offline detailed types of things that will come into play as you get into this process. Obviously, you write a sales contract. When you write a contract, you typically have an earnest money deposit check, which is just a good faith $500, $1,000 to show the seller that you're serious. In the process, you have a home appraisal, you have title work, you have homeowners insurance, which you've seen on TV, Allstate, State Farm, Progressive, etc. If you're in a mandatory flood zone, you would need flood insurance. And of course, you'll have an attorney or a title company, closing company, that will do the title search, the title work, and close your loan. Generally, again, your attorney or your title company, if you know one or if you trust one that you have in your network, those are the people to go to. If you don't, talk to your friends that have bought homes, talk to your family that have bought homes, and find the one that you trust. All right. Now, I intentionally went through that in under 40 minutes so that we could answer questions. Please keep in mind, and I know we went through this rather quickly, but we have about an hour and I want to get to your questions. Please feel free to reach out to me directly. More than likely, in my loan officers that work in our department, you will be working with one of them. However, I don't mind being your point of contact initially if you'd like general questions, general information, or to help me hand you off to one of the loan officers. You can reach out to the credit union directly. You can walk into a branch and ask someone to refer you. They will send you into our department, and we will make sure one of the loan officers who works with that branch is the one that reaches out to you. If you call the call center, we will assign a loan officer to you from the call center. They will refer them into the department, and we will also refer them. All right, so let me go back. I've got multiple questions. So here's what we're going to do. From Brittany, how do we get those scores? So great question, Brittany. The only way to get the actual ones the lender pulls is to have the lender pull them. However, I'm not a big fan of a lender pulling your credit scores just for the sake of getting them. Not that the inquiry itself would cause your score to drop. That's actually an old wives' tale. That is not actually accurate 100% of the time. Sometimes it is, but oftentimes one inquiry generally will not have an effect. However, unless you're actually applying for a mortgage, it's probably better not to have the lender pull the 3 scores just so you know what they are. Now, in some cases, you would want that done if you said, you know what, Dave, I know I need work and I need to know what I need to work on. That might be a little different And that might be an example of a time when we should, so that we can coach you and guide you. Now, we're not credit counselors, so we're not in-depth credit counselors from that point of view. However, we can, with you, go through the report and give you guidance. Paying down the credit cards, for example, like we talked about, paying off collections, things like that. So we're absolutely happy to help with that. If you don't need them for reasons of needing work to be done on your scores, if you're confident that they're fairly high, I would suggest, instead of having the lender pull them, you keep an eye on your Credit Karma, watch it, make sure it stays where you want it, and then at the time that you're getting near ready to pre-qualify, that would be the time to pull them from the lender. All right, Veronica says, my credit report shows a car payment, but I'm a co-signer for my daughter, but my daughter pays it. Do I have to include it in my debt to income ratio? So when you have a co-signed loan, so you co-signed for your daughter, it's her car payment, but it shows on your credit report because technically you're automatically responsible. In some cases, we would not have to count it against you. And I stress the word some cases. Technically, you are responsible. Technically, it is part of your debt to income ratio. However, in certain circumstances, and forgive me for sounding vague, if you have proof that the daughter has been paying for it for at least 12 months, and that would typically come in the form of bank statements. You know, here's 12 months of bank statements proving the daughter paid it month in, month out, month in, month out, etc. It's possible, and I say the word possible, not to sound vague, that it's possible we might not have to count it. Now, if you qualify with it anyway, then you're good. It doesn't matter. If you don't and you need to not count it, make sure you and the loan officer put your heads together, get the proper documentation, and the loan officer will determine if that loan program, VA, FHA, USDA, conventional, etc., if the loan program will allow it. So it's not a blanket situation where you always can't count it, and it's not a blanket situation where you always have to count it. It's going to be situational. That's a great question. All right, Eric Gorman says, can you have too many cards? That's a debatable question, Eric. There are those who would say you could. However, I've never seen anyone who had too many as long as the balances were low compared to the limit. So for example, if you had 5 credit cards and they were all paid off, your scores from those 5 cards are going to be significantly better than if you had 1 card and it was maxed out. So I don't know if there actually is a number of cards that's too many. However, I would simply say, as long as you manage them properly and keep those balances in that low zone, you should be fine. Now, if you said, well, I've got 50 and your credit score was still 780, well, I guess that shows that there's not too many. Probably case by case, but great question. Cindy Duell says, we are currently paying off credit card debt. How far should we get ahead? Should we get pre-approved as it will continue to get better? That's a question. That's an awesome question, and I actually get asked that quite frequently, because when you're paying off credit card debt and getting those balances into those low zones, right? There's a delay between you paid it down this month, but you're not going to get the benefit from it until Capital One, for example, reports it next month. So I think in terms of how far ahead you should get pre-approved, it probably depends on how fast those cards are going down, and as a result, how many points do you need? Are you trying to grow your score by 20 points or by 80? And so depending on how many points you're trying to get will probably dictate how long you need to wait. If you only need 10 points and you paid 2 cards down way below, and the very next month your 2 cards reported and boom, you got your 10 or 15 points, well then there's probably almost no waiting at all. If you had 80 points to get and you knew it was going to take 10, 15, 20 points a month, then obviously that could take longer. So I would recommend in that case, get with your loan officer, determine what the gap was. You're trying to get 10 points or 100, and how fast your timeline was on getting those cards down, and then sort of gauge with them approximately how far you felt like it was likely to take. It's not perfect. It'll never be an exact science, but it will at least give you the guidance you need to know when to proceed. All right, next question is, how do I get pre-approved, apply online? I think that's the best way. It's safe, it's secure. You can give your information over the phone to a loan officer, that's fine. But I believe that doing it online is more efficient, it's safer. You don't have information flying around, it's right there on the app. All right, next question is, does First Advantage offer all loans available? Phenomenal question. So I'm going to say we do not offer every single loan in the industry. However, we offer all of the major ones, the ones that almost everybody gets. For example, VA for veterans, we offer that. FHA, which is a non-veteran type loan with a small down payment, we offer that. Conventional loans, which is a generic loan for those who are not going FHA, they're not a veteran, and they're putting some money down, we offer that. USDA, United States Department of Agriculture. These are loans with income limits and geographic limits, meaning they have to be in areas that are either rural or semi-rural. So cities like Newport News, Hampton, Poquoson would not qualify. Counties like Gloucester would, Isle of Wight would, New Kent would, parts of York County, parts of James City County, we offer those. At the moment, for example, one loan we do not offer is construction loans. So if you're wanting to buy land and build a house, unfortunately, that's not a loan product that we currently offer. Next question. How about student loans? How is this impacted in the process? Well, student loans, that's an exceptional question, because student loans have a couple moving parts to them. Number one, if you have a payment that you're paying, then that becomes part of your monthly payments of your debt to income ratio. If it's in deferment, then depending on the loan product, the lender might have to count a specific payment, even though it's in deferment. So that one, I would say, if you have student loans, particularly if they're in deferment, things like that, get with your loan officer, and as they walk you through the loan products and all of the individual uniquenesses of those loan products, they will guide you on whether or not the deferment matters, whether the income-based repayment plan you're in matters, etc. Excellent question. What are the income limits for FHA and USDA? Great question, Eric. So FHA actually does not have an income limit per se. USDA, however, does, but it's based on how many people are in your home. So if you actually Google, or you can have us help you, we can show you where to go and we can pull this up and guide you. But you actually can go to the USDA website and you would Google USDA income limits. It's not quite that simple. You'll have to navigate a little bit, and this is where we'll help you. But you can actually pull up the geographic area you're in, how many people are in your household, and it will literally tell you what the income limit is for USDA in that area. Great question. Next question, do you help with informing what you need to work on to get approved? Absolutely. We're more than happy to guide you, give you assistance. Again, we're not credit counselors per se, but absolutely we want our members to know that we are going to help them and guide them and give them advice on what they need to do, whether it's debt to income ratio related, meaning it's the income and the payments, or whether it's credit related, you know, how to get the scores up. So yes, Amira, we absolutely will do that. Shalita says, who or how do you recommend we go about getting pre-approved? Just go to First Advantage and get them to pull the credit. Is there a soft pull to estimate what you would qualify for or not? Great questions. You can go online, put in a full app, we'll pull credit and we'll figure it out. Or if you'd rather not have credit pulled at the moment, we can with a calculator. Now, this is not going to be a true pre-approval. This is just going to be an assistance. If you said, hey, I make, like this slide said, I make $5,000 a month. My mortgage payment that I want is $1,200. My debts are $800. My debt to income ratio is 40%. We can help you with that part of it. We wouldn't be able to fully pre-approve you without credit, unfortunately, but we can do what I would call the prep work to try to see where you were at. And then at that point, you could say, wow, my debt to income ratio looks like it's fine. My job stability looks like it's fine. I've got the money I need for down payment, you know, et cetera. Okay, now I think I know what my credit score is, or at least I think I know what it is. Now I'm going to go online and apply. So we'll absolutely help you on the front end. We can't send a pre-approval letter or pre-approve you in the true sense, but we absolutely can do the front end work for you and with you. Antoinette says, if you had to change careers because of the pandemic, can that mess up the process? It depends. It could, but it depends on what the career change was. If you change careers and your income was still considered stable, particularly the same industry, particularly if the income was a salary type where it's more guaranteed, like a teacher or, you know, an engineer somewhere at Jefferson Lab or whatever, it likely would not mess you up. It really depends on the history of your employment coming up to that point and what the employment was that you changed into. I do think it's important to probably discuss that with your loan officer to say, hey, here's what I did, here's when I left, and here's where I went, and here's how I'm getting paid now, if that makes sense. All right, John says, does having a no down payment loan like USDA raise APR? Not really, because the thing with APR in the generic sense is it's based on the fees and the costs. So the no down payment part of it would not necessarily raise APR. It might be a little higher than a down payment type loan, but it wouldn't be significant. Veronica said, thank you for answering my question. You're welcome, Veronica. Marcus, what is the difference between a mortgage credit score and a standard credit score? That was kind of the one where we talked about the mortgage lender is going to pull from the bureaus directly, from all three, and almost certainly those are going to vary to some degree from the consumer ones like Credit Karma. However, the consumer ones do at least give you some guidance, particularly over time, and tell you whether your score is rising or it's not, and those are a good guide. Lisa says, what's the income limit for down payment program assistance? So it depends on the program. If it's the USDA program, it depends on family size. If you are going with a different product called VHDA, which we do not currently have, they do have income limits, and fortunately, they post them on their website. So if you need to, you can call me or email me. I can help you find the website and where to go look for that. But there are income limits for almost all down payment program assistance situations, but they'll vary based on the program. Do you have to have a 650 score with a conventional and DTI if school loans are around 100,000? The score is going to vary based on programs. Some programs will take scores down to 640. Some will not. If the school loans are around 100,000, it does not necessarily mean that's bad. It just depends on the program you want and the payment on those loans that we would have to count against you. Whether we could count the income-based payment or the real payment, or whether we'd have to use an arbitrary percentage if they were in deferment. How long is a pre-approval good for? This is a great one. So pre-approval letters technically have expiration dates only in the sense that they're based on your profile at the time. So there's not necessarily a drop dead date for them. However, what I would recommend is your pre-approval is only as good as your qualification at that time. Meaning, if you come back 5 years later, well, obviously the pre-approval letter is probably not valid because it's been 5 years. But if your profile was still as good as it was originally, more than likely you'll be pre-approved again without any problems. I would recommend that when you're going for pre-approvals, you're probably going for it because you're looking for something soon. 30 days, 60 days, 90 days, 120, 150. So make sure when you get that pre-approval letter situation, make sure your profile, credit, income, assets, make sure they all stay the same or better. You simply just don't want them getting worse, so that if the lender has to pull that credit again after the 90-day expiration, the situation hasn't changed, or you haven't, changed jobs and you have make less money, things like that. So if your profile stays the same or better, there's a strong likelihood the pre-approval letter's good until you find that house, assuming it's not an excessive amount of time, but make sure that your profile stays the same or better. All right, I've got one question here from Alexis. And Alexis, if you're still on the line, it looks like it's a question that needs to be answered maybe directly. I would like to I'm going to hit a quick reply and ask you to call me, if that's all right. So I'm just going to do that right now. All right. Marcus, why would a person have a 617 Equifax and a standard credit score of 694? That's a great question. I think it's quite frustrating that the credit scoring industry and the models can sometimes be so inconsistent. Sometimes you'll have a creditor only report to 1 instead of all 3. And as a result, that one scores better or worse by a wider margin. There's really no exceptionally good explanation for that, other than to say that the models have slightly different, or the bureaus, I'm sorry, the 3 have slightly different models, and occasionally some creditors report to 1 instead of 3, or 2 instead of 3, and things like that. Or a collection may only report to Equifax, and therefore the Equifax score is low. Barring those things, it is terribly frustrating to see the discrepancies between the 3 often. Next question from Cindy. If we want to buy a house in summer 2022, when should we start the process? Well, generally I recommend you start the process somewhere in the 60 to 90 day pre-buying time frame. You could always get pre-approved farther ahead than that, but of course your credit report will expire. I think the key is if you know your debt to income ratio, and you can discuss this with your loan officer to make sure you're right. And if you know your credit's really, really good, you probably, if you don't have anything to work on, you probably don't need to technically start it any sooner than about 90 days prior to buying. Let's see, I think we already did this one. What is the difference between a mortgage credit score and a standard? Well, the mortgage is the tri-merge from the 3 bureaus. Standard credit score, I'm assuming, means consumer. And because the consumer models are not the real scores, they can often vary just because they're a model based on the bureaus. Let's see, what's the purpose of an attorney at closing? What exactly do they do? So what the attorney does, or title company, because you can use either, in both cases, they do a title search. They go down to the courthouse, make sure the title that you're buying the house on has no liens, has no encumbrances, has nothing that would prevent that title from passing clear to you, kind of like buying a car. When you buy a car, you get a car title, but you don't want a title that's got, a loan on it or some other thing preventing you from clear and clean title passing. So that's a big part of what they do. They have multiple other functions, but that's one of the main ones, is to make sure that that title is clear and clean. They're going to assist you with closing. Now, the only real difference between attorneys and title companies, because you can use both, or either. A title company performs the exact same function as an attorney when it comes to closing a mortgage. However, the one singular difference, which may or may not matter to you, it certainly may or may not matter to many people, because there are hundreds of thousands of people that use attorneys and hundreds of thousands that use title companies. The one thing an attorney can do that a title company cannot is they can give legal advice. Now, you may not need legal advice because the real estate agent's helping you on the front end with the contract, etc. But a title company technically cannot give you legal advice because they're not an attorney. All right. Is it better to go through a bank or credit union or a mortgage lender? Great question, Autumn. I think it depends on your personal preference, number one, and what makes you happy. If mortgage lenders and credit unions and banks, for argument's sake, are generally about the same when it comes to, rates and service and things like that, assuming that. Now, that's not always the case, obviously, but assuming that, I think it would come down to personal preference. Who are you comfortable with? Who are you going to want to work with and make you feel that you're in good hands? Carlisa says, what is the credit score requirement? Depends on the program, but generally speaking, the government programs, VA, FHA, and USDA, as a general rule, now remember, we talked about that score alone is only one piece of the puzzle, but generally speaking, in today's environment, generally a 640 plus is the minimum requirement. That's varied over the years, but in the current environment, that seems to be the threshold for government loans at the moment. And of course, that would be the middle score of the three. Conventional loans are a little different. They tend to require higher scores. So that score could be something higher than 640. More than likely, you would have to have something higher than that for a conventional. Steve again says, same question from somebody else. How much in advance should you start the process? I think if you know you're qualified in terms of, your Credit Karma is great, and you've run your debt to income ratio with your own calculator, and that's great, you've talked to your loan officer, I think you want to be within about a 90-day window, simply because credit reports are good for 90 days. It does not mean if you ran past that date and you pulled another one, your score was going to tank. That is actually not the case. In some cases that could happen, but it's not typical. But that's about the timeline that you'd want to be in if you only wanted it pulled once. Since they're good for 90, you want to make sure your process started and ended in that window. Veronica says, oh, this is a good one. Pull your credit report for free until April 30, annualcreditreport.com. That's good advice. Let's see. Now, here's a question I'm not sure I have the answer to, so I may have to bring Amber in on this one.
Sure, David, I see it. So the question is asking if this will be available for viewing at a later time, and it absolutely will be. We'll be putting it on our website at firstadvantage.org under the mortgage section, and we'll also link to it from our Facebook page. So if you don't follow us yet, head over to Facebook and follow us, and you will get a notification as soon as we get it posted.
Love it. Good stuff. Let's see. Let's see. I see the same question again. I think purpose of an attorney at closing, and we talked about that. This is a question from Shalita. She says, at what point of the house hunting process should we reach out to the programs that can assist with down payments or closing costs? I think the sooner the better. If that is an area that you're looking for, as an example with grant programs, things like that, I think the sooner you start, the better, so that you make sure that you fit in the program, that you qualify if there's an income limit or things like that. So I would recommend you don't have to do it a year ahead, but if you're looking to buy within the next 90, 120 days, maybe 150 even, I think you'd be well served by looking into that now. And the loan officer will help you with that. Let's see. Stephen says, how much does it cost to get a pre-approval from First Advantage? It costs nothing, Stephen. We don't charge for that. The only cost you'll ever have in a loan process with us is if you have a loan in process and you'd have closing costs, etc., of which you would only be paying what the seller was not. So we don't charge to get you pre-approved. Let's see. Cindy says, I'm currently in the federal loan repayment plan where my loans have an end date. Does that impact the DTI only after it's been forgiven? Great question. So it sounds like you have student loans where after you've been teaching, for example, at a school or something for a certain period of time, the loans are forgiven. Unfortunately, I believe we have to count them until they're forgiven. And the reason for that is that, as an example, if you were a teacher and you were 5 years into this 10-year work window and then they be forgiven, technically you could leave teaching and you could say, you know what, I'm not going to be a teacher anymore, and therefore your loans would not be forgiven. So unfortunately, while you have them, we have to count them, but until they're forgiven. Let's see. Great question here from Ona. It says, what if you're not satisfied with your pre-approval amount? You want more? Would you have to wait and reapply, or some type of guidance, or would there be some type of guidance to get the amount you want? I would say, of course, we're going to guide you, and that would be something where, as an example, in your question, you were told, hey, you qualify for X. That would be important then for you and your loan officer to discuss, hey, this and that really doesn't get me what I want. What can I do? And that's an area where they can then guide you to say, hey, if you'll do the following, make some kind of a plan, whether it's income related, whether it's debt related, to help you, whether it's down payment related, or putting more money down. I definitely think you should get with the loan officer and create a plan on that. And yes, definitely, we would love to help you with that. Marcus says, I did want to know about the different modules of scoring the mortgage for Equifax and the standard. I'm not sure I understand what you meant by modules. Well, they do, when it comes to, I think what you're asking is, how do they score the individual accounts? There's really the three key things. Installment loans, you just want to pay them on time and you'll pick up some points. If a person were to have collections, you just pay them off and that'll stop the bleeding, so to speak. And on credit cards, you just want to get those balances down below that 25% to help you get those bonus points over time. Beyond those three things, I hate to admit it, there doesn't seem to be much else we can do as consumers. There's no other unfortunate magic other than just doing those things and doing them over time. Keisha says, my lender says I should take a class before buying a house. Have you heard of this? Actually, you can. I mean, it's not, well, it could be required based on the program. So there's some programs that actually require it. If your program did not, but you felt like, gosh, I'd really like to learn more. That's a great idea. Let me reply back to all. VHDA has first-time buyer classes. And you would go to www.vhda.com and they do online classes, and I don't know if they're still doing in person. So we're going to send this to everyone. So I don't know if they're doing them in person, but they will have on their website a section you can go to for home buyer education, and you basically put in the area, Hampton, Newport News, York County, Poquoson, et cetera, and it'll pull up all the classes they offer. I know they do them online, obviously, and they were doing them in person, I'm sure, up until COVID, but I can't tell you, I haven't checked in a while. I can't tell you whether or not they're still doing them in person since COVID. Let's see. Shalita asked, for closing costs, is that paid all at once if the buyer has to pay some of it, or do they pay it as each part of the closing comes up? So closing costs are paid at closing. So fortunately, they're not paid prior. So once it's determined, you know, hey, the seller's paying this amount and I'm paying this amount, or however that part of it is negotiated, all of that's paid at closing. The one exception, the only exception, well, there are two technically. Number one, if you want a home inspection, which most people do, that's something you do pay at the beginning of the process after your contract has been accepted. In terms of the second is the appraisal. The lender is likely going to require you to pay for the appraisal when it's ordered as part of the lending process. After your contract, after your home inspection, the lender is going to want an appraisal. However, if the seller is paying it on your behalf as part of your total closing costs, you would technically get that back. So a VHDA mortgage, that's from Marcus. That's the Virginia. Let me type it in here real quick. That's the Virginia Housing and Development Authority. And they are a state bond agency right out of Richmond. And they do have some programs that will have some down payment assistance type programs, as long as you have income below the limit for family size, etc. And they are also the ones that provide the they do provide a first-time homebuyer training class. If you're a 1099 and behind a couple years on filing, do you need to have those filed? Yes. So when it comes to tax returns, if you're self-employed, either as a traditional business or you're a 1099 contractor, unfortunately, you do have to have tax returns brought up to date in order to get a mortgage. If you're renting and want to buy, how far in advance? Again, more than likely somewhere in that 90 to 120 day range. A little farther if you think you might, want a little help on maybe getting scores up and things like that, so that you're not caught with having scores that aren't where they need to be, but you don't have time to get them up. Does using a down payment assistance program affect your credit score? No. That is just a perk of a down payment assistance program. It's there for you, but it doesn't hurt or help you with score. Tayo says, what is the first step in buying a house? Get pre-approved or look and find a property and then get pre-approved? Well, I'm going to give you my opinion, but not everybody does this. So in my opinion, you should always get pre-approved first, only because it prevents the scramble. You went out on a Saturday, you found a house, your agent turns to you and says, houses in this market are flying off the shelf and we're going to have to make an offer today. And you're like, hey, that's great. I want to buy it. Let's do it. You sit down, you write the offer. Your agent turns to you and says, hey, by the way, we need a pre-approval letter from your lender. And you say, well, I don't have one. And the agent says, well, the seller's not going to even look at your contract without one. And you say, oh, gee whiz, and it's Saturday at 7 p.m. And by the time you get a hold of your lender, and by the time you get your docs to them, and by the time you get pre-approved, it's Monday and the house is gone. So I'm going to say you want to do it first. And your agent's going to tell you the same thing. In fact, sadly, or maybe properly, many agents won't even take people out to look for homes without the pre-approval letter, because the market's so hot. They don't want to be driving all over the place and then, writing offers that won't even be looked at. So question here based on the student loan thing, would you count my income-based payments in the DTI? And I'm pretty sure that's related to student loans. Depending on the program, so some programs will count the income-based payment on a student loan, and some will not. They will require the lender to count an arbitrary amount. For example, you have 40 grand in student loans, your income-based repayment is 40 bucks a month. Some programs will use 40 bucks a month. Other programs will require 1% of the balance, even though you're not actually paying 1% of the balance. So that'd be 400 a month, for example. So it depends on the program, but some of them do allow the lender to count the income-based payment for the student loan in the DTI. And you're welcome, Keisha, for getting your name right. My first realtor I feel tried to pressure me into a buyback. Is this a Texas thing? Why would I buy a house and let the owner stay there for free for months? Can you shed light? So let me read the question again. My first realtor I feel tried to pressure me into a buyback. Why would I buy a house and let the owner stay there for free for months? I don't think I would do that if it were me. I don't think I'd want to buy a house and let the original owner stay there for free. That wouldn't be something I would recommend. Now, there are cases when a buyer wants to buy a house, but the seller's not fully ready to move, and the seller asks if they can rent back for 2 weeks or 3 weeks until they get their stuff together with Mayflower Moving Company and move. I'm not saying you should do that. I'm not saying you shouldn't do that. I'm saying some people do it. Not very many, but some do. But I don't think I would be all that comfortable for doing that for months. Does First Advantage offer VHDA? Unfortunately, we do not, but it is a great program, particularly for the down payment assistance aspect of that. What is the impact of the VHDA class? Is it knowledge-based only, and is it compulsory for the first-time owner? So it is required if you're getting a VHDA loan. So if you're getting a VHDA loan, you do have to take the class. It is a requirement. If you're getting a different product other than VHDA, with one exception, first-time homebuyer classes are not required. They are for your purposes only, for your knowledge only. There's one other product in the market. We don't have time to go into detail, but that does require a different first-time home buyer class for that specific product. It's a very niche product. Let's see. I'm a first-time home buyer. What would be the best loan? Well, it depends, and I know that sounds like a vague answer, and I apologize if it seems that way. It really depends. As an example, if you're a veteran, you might want to go VA for veterans. If you're out in a rural area, USDA is great. So all of the programs can be, quote, the best loan for a person who's a first-time buyer based on their situation. Are they putting money down? Is their credit 650 versus 750? Are they buying out in the country? Do they have income limit situations? So without sounding too vague, any of them actually could be the best loan based on your situation. And I apologize if that's not specific enough. Do first-time home buyer benefits still apply if only one person on the loan is a first-time buyer? So as a general rule, great question, Brittany. As a general rule, first-time home buyer programs by their design require all of the buyers to be first-time buyers. So that's the general rule of thumb. We'd certainly love to talk to you about if you have a unique situation where one's a first-timer, one is not. But as a general rule, first-time homebuyer type programs and grants and things like that do tend to apply only if all the buyers are first-time buyers. All right. Let's see. We got maybe one more. Hold on. I think we do. Yep, we got one more. Lisa, let's see. If your score is right at 700, what's the difference with applying for conventional versus FHA? I'll give you the generic answer just so we don't take up 20 more minutes. Generally speaking, conventional loans tend to be, and I'm going to be very broad with this because there are exceptions, but generally speaking, conventional loans tend to be the better product when the scores are in the 740 plus range, and FHA tends to be the better product when the scores are not, and particularly if they're under 700. Now, in between the two, 7 to 740, it's debatable. Under 7, FHA is more than likely better as a product. Over 740, conventional. But there are exceptions to that. For example, person's got a score of 695, but they're putting 40% down. Conventional still might be the better product because of the big down payment. So sorry that that's not super detailed, but that's kind of a generality. I believe it's Linnea. Are there programs for nurses? There's probably some out there. We don't currently have any programs for nurses or doctors per se, but that does not mean that there aren't some in the market. So we don't have any, but I would not preclude there being any programs for nurses that are in the industry. I wish I had a better guidance on that for you, other than maybe to, God forbid, but I would say Google and start surfing around, or maybe even call around and start, getting some insight onto whether certain lenders have them or others do not, and things like that. And yes, if any of you have specific questions, please feel free to email me. You're not obligated to take an application or get pre-approved or do any of that. We're here to assist you as members and guide you in whatever information you need, whatever help you need. That's what we're here for. And I'm absolutely more than happy to take your calls and your emails to guide you. And I think with that, I believe we're at the end of the questions. Thank you for allowing me to go on so long. Appreciate your time. I know we're already at 6:20 or so. I really appreciate all of you showing up, taking time out of very busy schedules. I know we didn't cover every single thing about lending, but we covered a good overview, and any other things of any kind that you need from us in terms of questions or information, please reach out to me or reach out to others. And I did see Shalita says, Linnea, go to teachernextdoor.us for your nurses program, teachernextdoor.us. All right, well, I think that's it. Amber, thank you for helping put this on.
Yeah, absolutely. Thanks, David. You gave a lot of really great insight, and thank you all for attending tonight. As we mentioned earlier, the webinar it is recorded, so it will be made available online probably tomorrow afternoon. So we will be posting that onto our firstadvantage.org site, and we'll also post it onto our Facebook page. So thanks again, David, and I hope everyone has a great night.
Thank you all. Have a great evening.